Ladies and gentlemen, my name is James Marlay. I'm the co-founder of Livewire Markets, and I'm joined by Kee Gan, who is the Chief Investment Officer of L1 Capital's UK property investments. Now, many of you would be familiar with L1 Capital's Australian and global equity offerings, probably a little less so about the UK residential property investment opportunity that they've got. They've been running a couple of funds for a while now. Kee is going to talk us through the opportunity that they see and tell us a little bit about what they're investing in, their process for selecting investments, why the opportunity exists, and a bit about the fund structure itself. Kee, thanks for jumping on the line.
Fantastic, James, and good to connect. So, I think it's probably a bit helpful just to set in context how it all started. As you mentioned, a lot of people are more familiar with our equity funds. So around 3 or 4 years ago, when I was working in London, I made a personal investment in an apartment in Birmingham, and there were a number of some interesting themes. So one, the rental yields were very high by global standards. So I was achieving somewhere between 7 and 8% rental yield. Interest rates were very low, so I was able to borrow at a mortgage rate of about 2%. And it became one of the very few developed countries where you actually got positive gearing, so a positive dividend yield on your equity, versus most countries, including Australia, where you actually sat on negative gearing. When I sort of looked at where house prices were in the cycle, they were actually very late and slow to recover from the GFC. So from an affordability perspective, outside of London, where about 85% of the population actually lives, price to income ratios was about 4 times, which was a lot lower than London at 8, Melbourne and Sydney, and in comparison trade between 9 and 11 times, respectively. At the time, with a bit of uncertainty around Brexit, the sterling was also very weak. So with that sort of dynamic, I thought actually a lot of asset classes around the world quite expensive. There's actually something which provides a very strong yield, predictable yield, with some scope for capital upside. So I caught up with Mark and Raf from L1, and we were talking about investments, and they said, actually, this is a no-brainer. And their immediate response was, we'd love to actually put a lot of our own money into it. And over a period of time, they said, actually, a lot of our clients would actually find this as a pretty compelling opportunity, because when you look at Australia housing, you just largely see the opposite: low yields, negative gearing, affordability, very, very stretched. So moving on, over the past 3 or 4 years, we have now raised 3 funds and invested 3 funds across the asset class, and currently have about 250 million Australian dollars assets under management.
Property is like the favourite dinner time conversation for Australian investors. What's the context for residential property in the UK? Do people have the same level of obsession? And people feel like perhaps the opportunity for investment in Australian property has passed, or temporarily at least. What's the opportunity that exists in front of you right now?
Yeah, sure. So what we invest in is basically blocks of apartments in the tier 1 cities outside of London. So cities such as Manchester, Birmingham, Leeds, and Sheffield. And what we like about these cities is one, prices have only really started to recover to the same levels they were prior to the GFC. So really you've had 10 or 12 years where prices haven't moved all that much. Yields are very high, affordability very strong. And when we look at a lot of these cities, they're benefiting from an outperformance of employment and population growth. So, for example, Birmingham, Deutsche Bank, Santander, NatWest have moved a lot of the middle office to Birmingham. BBC moved to Manchester. You've got around 2/3 of the FTSE 100 who have now an office in Manchester. So a lot of firms are opening up in a lot of the tier 1 larger cities outside of London, a bit more for affordability. And what we're finding in terms of value, we think longer term, the gentrification will support house prices in those regions. And then when we bring it together to say, well, what's the investment case? There's cities which we like the long-term outlook. There's a strong running yield where we're able to get strong positive gearing. So the fund generates historically around between 6 to 7% dividend yield just purely from income. And if house prices continue to remain stable, or if we continue to keep repositioning the assets through refurbishment, serviced accommodation, lifting the rents or under rent and under managed assets, that's what we feel fairly comfortable that not a lot has to go right to deliver a relatively double-digit return. To your question around, well, why does this investment opportunity exist and why does it look so different to Australia? It's very much driven by mortgage lending. So in 2009, 2010, the UK banks had a very different experience where they all became bailed out by the UK government. So Lloyds, NatWest, Santander all became nationalised. And mortgage lending has become very, very conservative. So the average LVR for a new mortgage, if you can actually get one, is about 60%, which means people finding that 40% deposit makes it very hard for them to actually make that purchase. So right now in the UK, 68% of all people who rent are renting because they don't have a deposit to actually buy a house. So it's not really driven by affordability, because if you're paying rent, which is 7 or 8% rental yield, but you can actually buy a home on a mortgage of now less than 2%, it's actually much cheaper to buy than it is to rent. And it's that conservative nature of the banks of where they are today, holding back lending, that's holding back prices. And we think that actually makes it very interesting, where it's not about affordability, it's not about the location so much, it's actually the banks which are actually holding back lending.
And on that front, is the likelihood that credit discipline from the banks is likely to change over time? Is there any discussion or movement on that front?
Yeah, so just prior to COVID, mortgage volumes started recovering, and some banks started moving into a bit more of the space of offering higher LVRs, up to 75%. I think COVID's probably put a little bit of pause until the banks have a bit more clarity, but the long-term trends are 2 or 3 years ago, the majority of the UK banks had their government shareholder exit the share register. So becoming fully publicly owned again is a differentiator. And then I think, secondly, the UK banks are now actually very well capitalised and now want to actually grow the lending book. So I think once there's a bit more clarity around the COVID, the longer term focus is to actually regenerate the housing across the UK. What the UK banks are very conscious of is there has been obviously a structural shortage of new housing that's been coming into the UK. So the UK long term has had household growth about 300,000 people per annum. Not a big number when you've got 65 or 70 million people in the country. But over the past 15 years, the number of new dwellings built is about 170,000. So they've been building about half the number of household growth. And part of that stifled it is really banks lending to get people on the mortgage ladder. And part of that is to really get lending back into play. So there is a big focus on that. And I think that's something that will happen over time.
The experience in Australia has been that rents have fallen during the COVID period. Has that been consistent in the UK?
Yeah, so the UK has been a little bit different. So rental prices have remained actually relatively very resilient. So when we moved to the month of July, outside of London, rental prices are up 3.4% versus last year. In London, they're actually down 1%. So hence one of the reasons we focus less on London. But what's happened in London is it's driven by a lot more international tourism, a lot more Airbnb service accommodation. And with the fall of that foot traffic, they're focused on the private rents. So there's a lot more supply in London. Outside of London, which is a place where people live, rents have continued to move up. When we actually look at how rents have performed over the past 70 years, what we've seen is it just consistently grows at around between 2 and 4% in line with inflation or people's incomes growth. And the worst year, which there was a decline, it only fell 0.8. So it's actually a very stable product. The other aspect that we did look at and pay a lot of attention is have people continued paying their rents throughout this period, particularly during a strong period of uncertainty around people's employment and jobs. So the residential sector year to date, and including the most recent months, have averaged around 97% collection rate. So 97 cents of every dollar that's meant to be due, people have paid. And in the worst month, which was in the month of April, that only dropped to 95%. So people have continued paying, just given a relative affordability. And that's been much stronger than other sectors such as commercial, where unfortunately the collection rates have been much lower, closer to 60 or 70%.
I want to talk a little bit more specifically about the investments in the residential space, but I also understand part of the fund invests in student accommodation. And there are some sweeter yields or higher yields on offer in that part of the market. Can you tell me about that opportunity, and if the yields are more attractive, higher risk, but perhaps the opportunity-wise isn't it a bigger part of the portfolio?
They do come with higher risk, and I think the way we put it into the portfolio is allocate somewhere between 15 to 20% of each fund into student accommodation. One, that allows us to be very selective, and two, it allows us to really pick the best one or two assets in each year in the student market. Each fund that we've raised to date, we've invested 2 student assets, and each of them have actually generated some very attractive yields. So, for example, in both Fund 1 and Fund 2, we invested in 2 separate student blocks on a Durham University campus. Both blocks were empty at that point in time, but what we were able to do shortly purchasing them was sign a long-term lease with the university, and that generated rental yields of 30% on one and 80% on the other. In Fund 3, more recently, we purchased 2 empty buildings, but in very central locations, one in Sheffield, one in Newcastle City Centre, and we just sort of said, look, if we do a slight refurb, let it up, based on just simple market rates, we would be at a rental yield of around 20%. So, wind forward that 6 months, we have actually done that. And given where the student market is today, people have actually looked to actually buy those assets, which we'll actually look to exit hopefully soon at good premiums to entry prices. So yes, the yields are very, very high. I think it does come with more risk because the student market is a bit more volatile than residential. But to date, with signing of new leases and repositioning those assets, we've actually been able to get some pretty good outcomes for investors.
So talk me through the typical sort of asset, or what is it? What is what is the fund? What is it made up of? What do the ideal assets look like? What do you do to them? What's the process? And maybe talk through also just some of the risks that you have to manage for and the complexities.
The typical asset that we would invest in would be a block of flats in one of the large city centre in the UK. So it would be somewhere in Manchester, Sheffield, Leeds, Birmingham. And what we're really looking for is not something that's perfectly run, but a building which we might find it's a little bit under rented, or the prior owner hadn't spent a lot of money on it, and we could do a light touch refurbishment. Or it might be sometimes it's run quite well, but the prior owner hasn't recognised, geez, it's in a really great location, and if we just put a bit more premium furniture or change the sub-agent, we could actually reposition the rents quite materially. So the ideal investment, number one, is strong city, a very good location within the city, and then we build a typical 3 or 4 year business plan of what are the 2 or 3 things that we can do differently. We get comfort that as a starting point, it's fully income generating day one, usually. So we know that there's a strong running yield that can start being returned to investors from the outset. And if we execute these 2 or 3 initiatives, so a bit of the sort of framework that I sort of used at Bain, that's where we can generate a bit more capital growth over the 3 or 4 year plan. And when we then ideally deliver that business plan, we then look to exit. And from then there's a number of options. So what we have from time to time is broken each building up one by one, so sell each flat at retail value individually. And a lot of that is from time to time to overseas investors, because when you buy a building in bulk, you typically buy it at a discount, you sell it at retail value, that you crystallise a premium. Or if that's not possible, given its location, sometimes it's also sold as a bulk deal as well. So that's typically the process from start to finish. Risks, it's a lot more around building quality, fire safety, and changes in regulations. So I think one risk that has become a lot more pronounced, which is significant to the fund, has been around cladding and fire safety. Particularly, we had a fire in Grenfell in London, and that's sort of rippled throughout the world. So now our process is much more focused around the building materials, getting the right certification, fire engineer to sort of review it, because the cost of now getting that wrong and having remedial action to fix it under our ownership can be actually quite expensive. So I think risks around building quality, carrying out the right surveys are absolutely critical that need to be managed.
So we've talked a little bit about capital appreciation, a bit about yield. What's been the experience for investors in those earlier funds, and what are you seeking to achieve with your current offering?
In the first two funds, which I think have had a longer track record, the distribution have exceeded our investment objective of 6 to 7%. So both funds are paying 7% or more. And that's coming out primarily from the rental income. So we like that it's sustainable, it's coming from income, and it's quite attractive in a low interest rate environment. In terms of total return, our investment objective is 10%. Both funds have exceeded those investment objectives because when you have a very strong income yield, it makes, there's not a lot that we have to believe to outperform that investment objective. So from a capital growth perspective, both funds have actually outperformed the underlying investment objective. I think going forward, as we look to Fund 4, I think the asset class and the opportunity largely remains the same. What's changed, I think, within our team is just really a lot more around the experience, how we improve assets, and how we can actually learn from some of the things that we might not have done so well in the prior funds, in terms of maybe this wasn't the right location, or we hadn't appreciated that this building would have a lot of costs more than we had anticipated. So it's those sort of learnings that we hope to actually improve for Fund 4 going forward and further enhance returns.
Mark and Raf put their money in the early rounds. The managers continuing to invest in these opportunities?
I think consistent with all our funds, all senior L1 staff do co-invest alongside investors on identical terms in each fund. I think across all the prior funds, the L1 team is probably the single largest investor, so very heavily invested in the strategy. And so we will be investing in Fund 4, probably not in similar amounts, but the conviction remains the same, and we'll continue to invest. So full alignment of interest.
Thanks for taking the time to jump on the call. Appreciate the insights into what's happening in the UK and and telling us a bit about your fund.
Thanks, James. Appreciate it. Thank you for your time.